Hello, this is Larry Tentarelli. I'm a full-time trader and the editor and publisher of the Blue Chip Daily Trend Report with a brief educational blog and video. What we're going to talk about today is I'm going to spend some time talking about the current value rotation that's underway, how I'm positioned, and more importantly, how I got myself and Blue Chip Daily members positioned ahead of this move by about 30 days. And I'm going to go through some charts and data that I saw at the time in a report that I shared with our members over a month ago. So before we get started, I'll touch base on the disclaimer, which says that everything in this video is for informational purposes only. It's not a recommendation to buy or sell any securities. So we'll get started with the video, and we're going to go back to November 30th. So on November 30th, as you know, Federal Reserve Chairman Jerome Powell, basically, he spoke to a Senate panel and he said that the Fed was going to accelerate their taper and tightening timeline, and that it was time to retire the word transitory to describe inflation. So markets immediately pulled back. That was November 30th. And from my experience in the markets, I've been in the market since 1998. I believe that the markets were going to enter a new cycle. So I shared with members that I was going to put together a special report for them on December 5th, which was a Sunday night. I put together for my members a special report and a 19-minute video titled Our View on the Fed Pivot. And basically what I did, I went through a lot of institutional research. I went through a lot of data. I went through a lot of charts, and I dialed back into my past experiences with these tightening cycles. And I wanted to share with members my best views of where we were and where I expected the markets to go. So we'll fast forward December 5th. I published the report and the video, and you can see I posted it to our members' Twitter page, December 5th, Our View on the Fed Pivot. And here's a screenshot. So I put together a pretty detailed look at past Fed rate hiking cycles. But the key thing I want to focus on for members is where were we right then, and how did I want to be positioned? So what I shared with members, and this is a screenshot from the special report, once we got down to the recap, is that I expected going forward, now this was December 5th, I expected going forward that outperformers would be high quality stocks with current earnings, stocks with cash flow, dividends, lower volatility stocks, lower valuation stocks based on a variety of metrics, and then strong relative strength stocks. But the real key focus was high quality, current earnings, lower volatility, lower valuation. And I've shared that. If you go back through my Twitter feed, I've shared that as well on the public Twitter feed, but not to the degree that I shared it with members. And at that time, energy, materials, healthcare, financial, select technology were groups that I expected to outperform. But the other thing, the groups that I wanted to avoid and what I expected to underperform were going to be long duration stocks with no current earnings, high valuations, high price to sales, high volatility stocks. So I went into great detail, and the core message was I'm going to focus on higher quality stocks, current earnings, lower valuations, and I'm going to avoid these stocks that have no current earnings and high valuations. So that was December 5th. And then I can say that over the last 5 weeks since my report to members and my video, the markets have played out exactly as I outlined. So if we go back 6 weeks, starting to November 30th, when the Fed changed their timeline, I put together this information 2 days ago when I put together this blog. This is the first chance that I've had the time to do the video to go with it. But so what this shows is that over the past 30 days, top 20 large cap stocks over 10 billion market cap, top 20 performers, we can see a couple things. So here's the top 20, here's the names, mostly cyclicals, but we can see that all are profitable. They've got some type of a PE metric. And their average forward PE ratio 12.52, trailing 12 months 2201, and their average price to sales is 3.65. Now here's the thing, I don't trade, I'm not a fundamental investor or trader, so I don't trade off of valuation. I always look at the charts, the technicals, the trend, moving averages. But what I want to do is if I see that the charts are lining up in such a way that aligns with some type of a shift in a sector or a style factor, then I want to be aware of that. So we can see top 20 performers over the last 30 days, low valuation, currently profitable, which is what I outlined for members. Now, if we look at the bottom 20 performers over the last 30 days, only 4 to 8 are profitable based on if we used either trailing 12 months or forward PE. The price to sales ratio, I can't use earnings because most of them don't have earnings, but the price to sales ratio of the bottom 20, 27.14. Price to sales of the top 20, 3.65. So about 8 times as expensive on a price to sales ratio. Then if we take a look, the weakness in the higher valuation, no earnings stocks accelerated over the last week, with 19 of the bottom 20 down by double digits over the last week before I put this video together. So keep in mind, in a nutshell, what I shared with members, we want to focus on quality stocks, current earnings, low valuation, and low volatility. Avoid stocks with no earnings and high valuations. If we look at the top 20 performers, exactly the model that I outlined. If we look at the bottom 20 performers, exactly the model that I outlined there. So that played out exactly as I expected it to. Now what I want to do is share with you exactly how I got positioned, because I share all of my trading activity with members in real time. So I started to get repositioned out of high beta growth in November before not knowing anything about what the Fed was going to say, because the charts were starting to weaken. And I'm going to go through these charts with you in a few minutes. But in November to early December, I booked gains or closed out the following positions below. So I share this activity in real time with my members. I send out an email before the trade, then I post it on the Twitter page. So I closed out Affirm, Airbnb, and just to take a look at this, this shows the price that I sold it at, shared with members, the recent pullback low, and how much drawdown I avoided by selling when I did. So on Affirm, the max drawdown, I avoided 52%, Airbnb, 23%, Asana, I sold it in the high 120s, low 130s. The recent pullback low, $56 and change. And we're going to take a look at these charts. Roblox, C, Snowflake, and Unity Software. These are all stocks that I sold, shared with members in real time in November or December. And we can see the drawdowns that I avoided. So we'll take a look at some of these charts quickly. So we'll start with Airbnb and just quickly. So Airbnb was a profitable position for me. I started to sell it here. And sometimes I'll scale out of these trades either on the way up, or if they start to weaken, I'll scale out as they weaken. Airbnb, I started to sell it here. I sold some more later. Drawdown was to 149 and change is the recent pullback low. Affirm was a profitable position for me. I started to sell it here. It started to weaken, and then we can see Affirm is down. The recent pullback low is 50% lower than my first sale. And what I do is I follow a very strict process. And you might know this if you follow me on Twitter. Once the trend breaks down on these stocks and they start to roll over, I'm not going to buy on the way down. I'm not going to hope for a rebound, average down, anything like that. I get into these, especially these higher beta stocks, with the intention that they're going to go up. Once they start to roll over, they start to lose that 50-day moving average, then I'm going to cut my position, protect my downside. So Affirm, we can see it's unwound quite a bit since then. Asana, I had Asana, it wasn't able to break out as soon as it started to lose this range right away. So I closed out this entire position well above the stop, right in this area. It was less than a negative 3% position for me. And Asana, as we can see, has been pretty much straight down. So I sold it, and I shared this with members in real time that I was selling this stock right here. It was 2 separate sales, and it's been pretty much straight down. Roblox, I sold that. So I wasn't in it all the way up, but in either case, I got stopped out of this position, and that's lower since I sold it. C, I sold this. I was profitable in this position earlier in the year. I took a new position. As soon as it broke the 200-day and it lost this prior low, I was out of the position entirely. And we can see that was 270 and change. Recent pullback low is 168. Snowflake, this was a profitable position for me. I started to sell it up here. That's down quite a bit since then. Unity, I got stopped on Unity, and that's lower since then. But what you can see is once these positions started to break down and these ranges started to expand, I was much more concerned, and I shared this with my website members, much more concerned with protecting the downside once I saw these charts breaking down. And I wasn't going to get caught up in the story that, you know, sees a strong company, they're dominant in what they do. But as a technical trader, when the chart breaks down and the trend turns, I need to get out of the way. So there was quite a bit of selling on my end, locked in a lot of profits, took some small losers, but I avoided a significant amount of downside. And that was shared with website members in real time. And then there's a post, I put together a blog, my closed trades for all of 2021. You can see those here with the actual breakdown. So now number two, number one was the rotation out of growth, these higher beta, and it wasn't out of all growth. I still have Apple, I've got Microsoft, I've got Google, I've got Tesla. But what I wanted to do is get out of those second tier names that had no earnings, that my research told me and my experience told me it could be tough sledding for a lot of those stocks. So number two was the rotation into the higher quality, lower valuation stocks. So I'm going to share some buys with you in a few minutes, but what I do for members, I put together what I call a chart of the day. It's a focus chart every single day, weekly top 25 list. But you can see just in December, after the Fed shifted gears, you can see that a lot of the posted ideas that I shared with members started to lean into the much more cyclical. Now, this is not all of them. This is just, I highlighted the cyclical or the lower valuation stocks. Obviously, I rotate it about 50-50 between growth ideas, high quality growth, and cyclicals. But you can see Ford has been a big winner so far, Chevron, Berkshire Hathaway. And what I did was I immediately started to add positions in these higher quality names. So the Fed shifted gears November 30th. On December 2nd, I had some cash. I immediately took a position in Apple and I took a position in Pfizer. Then through the course of December, I took positions in Schwab, Chevron, and Micron, among others. But these are either more value oriented or lower valuation stocks. All of these buys that I made in December, all of these stocks made new all-time highs after my buy. So we're going to take a look at this. And once again, keep in mind, this is shared with website members right away, emailed before the buy, posted on the Twitter page, complete transparency. So members know exactly what I'm doing, what the price is, everything. So Apple, I started this position December 2nd. We can see Apple made a new all-time high after the buy. Chevron Texaco, position was started here, a little bit of a pullback. That's broken out to a new all-time high. And Chevron Texaco, 24 times earnings. So remember what I mentioned to members: lower valuation, high quality stocks with earnings, dividends are a plus. But the key thing, keep in mind, it doesn't matter to me what any of this says if the chart's not working. The chart has to work for me. And if the chart's working, this really is insignificant to me. But when I see both line up, and that lined up with what the playbook was going forward, then that told me this is a chart that I want to get involved with. Micron, this is a lower valuation tech stock, 14 times earnings. So I sold Snowflake, and I think Snowflake is somewhere 40 to 50 times sales. I booked a profit in Snowflake, 40 to 50 times sales, and I rotated into Micron, 14 times earnings. Big difference. I got into Micron here. It made new highs. It's pulled back, but we can see that chart. And here's the key thing. I want to be involved in charts that are in uptrends, rising prices, rising moving averages, Those are the types of charts that I want to get involved in, not those charts that have rolled over like a Firm or a Asana. And it's not a knock on those stocks whatsoever, but I'm just trading the charts. It doesn't matter so much what this says. It matters what's happening over here. Pfizer, I took this position the same day that I bought Apple, pulled back a little bit, new all-time highs. And then Charles Schwab, I took this position the end of December, starting to break out here. And then this is, Schwab's been pretty much straight up. So once again, these buys are based on the technicals. The fact that the fundamental metrics lined up was a benefit. So we'll go back and then just wrap it up. And here's the key thing. So I rotated out of growth, shared this with members, and not out of all growth. I still have Tesla, I've got NVIDIA, I've got Google, I've got plenty of growth stocks. But I wanted to start to make that rotation so that I wasn't overly extended or have any exposure into a group that I knew or that I expected quite a bit was going to have a tough road to go versus a tighter Fed cycle, which is going to be a process, not an event. On December 12th, I expanded, we've got a weekly high dividend list, and I expanded that and it became the low volatility list because I started to add a lot more in consumer staples, a lot more in real estate for our members that were interested in these lower volatility ideas, because as I ran my screeners, these charts were coming up everywhere. A lot of consumer staples, a lot of real estate. And I did this because I recognized that a number of these stocks were breaking out or about ready to. So in recap, November 30th, the FOMC had a hawkish pivot. December 5th, I shared with members a 19-minute video special report, and I was very, very clear. And I said, this is the group I want to focus on: high quality earnings, low valuations, low volatility. Since then, energy's made new highs, banks have made new highs, the industrials ETF made new highs, XLB made new highs. So all of the groups that I said to focus on, these have all broken out, and some of them very, very sharply. The groups that I said to avoid, no current earnings, high valuations, high volatility, have had a very, very tough past 5 weeks. So this obviously preceded very sharp rotations. The high growth stocks that I sold declined afterwards. The low valuation stocks that we rotated into have made new all-time highs. So blue chip daily members were alerted in real time. And this was an every day, every night I do a video, a 25-minute or so markets video for members. And I go through the markets for the day, the key indices, the key sectors, and then I go through stocks that are improving that I want to focus on and stocks to avoid. So this message that I started to share with members on December 5th has been a constant everyday message since then. And that's how I'm still positioned. Now, obviously, I share the current perspective with members on a real-time basis. But I just wanted to take some time, share that with you, what I was looking at going in, what I saw on these charts, because the key thing is it's great to focus on the upside, and I want to focus on the upside while the trend is working. But once these charts start to break down, and I've had a lot of experience with this. In 2000, I went through this with the NASDAQ. In 2008, the great financial crisis, I went through that with the bank stocks and all of them. But once I see my positions, no matter how strong the company might be, how good earnings growth might be, whatever it is, once these charts start to break down, it's time for me to close out, protect my capital, and then reevaluate. And we'll see. See, we can take a look at the C chart right now. It's got some volume coming in. I don't buy into anything like this. I don't try to find the lows. I don't buy pullbacks and downtrends. I don't buy below a bunch of moving averages. So we'll see. This may start to be some type of a basing process. It might not be. These high beta stocks, the low could be in here. It could take 2 weeks. It could take 6 months. We don't know. I do know what to look for on the chart. I knew what to look for to get out of these stocks. And I knew what to look for to get into these stocks. And I know exactly what to look for on these rollovers if I see signs of stability and some base building. And I'll be sure to share that with members right away. So I just wanted to share that with you. I appreciate everyone's time. If you're interested more in the website, my website is bluechipdaily.com. And if you go on to our Join Now page, we'll just spend a minute and familiarize yourself with this. If you go to the Join Now page, you can see what the members' benefits are. And then if you go to the home page, if you go to the home page, you'll be able to find past closed trade alerts. So I appreciate everyone's time, and I hope to see you online soon. Thank you.